Deep Dive with David Stendhal, where we trade without ego, no emotion, no greed, and no opinion. Before we begin tonight's video blog, please read over our trading disclaimer and remember to trade smart and accept the reality that trading futures is risky. This presentation does not provide buy-sell recommendations, and our information is strictly provided for educational purposes only. As always, trade at your own risk and analysis. Hey, it's David Stendhal with tonight's Deep Dive. It is March 13th, 2018, and the market I'm going to look at today is the 10-year notes, the ETF being IEF. Now, the reason I'm going through this market is I actually had a client that was asking about it. So if you have questions, ask about a market, and I'll try to make it a focus when I'm actually able. So this is what we're really going to be focused on. It's in a trading range, meaning it's in a consolidation mode, and we can see that in two different formats. That's really going to be the focus of this presentation. But to cover the bases, we've got short-term trend, intermediate trend, and long-term trend all point to the downside. No doubt that it has been in a bit of a drawdown period. The technical rating is basically flat, giving us no indication. The seasonal tendencies are pointing towards a little bit of a bullish bias. If we take a look at our pro alerts, the thing that I want to point out is we have a lazy day 17, and what we're looking at is a consolidation from two different angles. One is just a normal volatility, and the other one is lack of explosive moves. Kind of the same thing, I realize, but it certainly is coming from two different perspectives. Before we jump into the chart, I just want to show this to you. We have a UVI index, underwater volume index, and what that shows is over the last 3 years, obviously not a long period of time, but in the last 3 years, we're at a low point right now with the largest drawdown that we've experienced for quite some time. Currently, we're down during this drawdown period, down 7.73%, and the max drawdown, which occurred just a couple of weeks ago, a couple of days ago actually, is 7.9%. It's almost 8%. So I'm just pointing out, historically, we don't really get down, at least over the last 3 years, this far, and we're now down to a support level. So let's just flip over here. First thing that I'll show you on the 10-year notes, the daily bars, this is the lazy day that I was referring to. And when we look at our value chart indicator, it has neither gotten into overbought or oversold condition. And when you have an extended period like that, and you see that they're in blue bars, the most recent one just simply saying that it's ongoing and just giving us the count, that's where the 17 represents, that this market has been moving sideways. It's almost like a huge sell-off, not huge, but big for the 10-year notes, and then all of a sudden an abrupt stop, and it's been moving sideways. Now we're at a support level right through here, and we're now coming up to, hopefully, well, it's actually the 50 days very quickly coming down to the market as opposed to the market abruptly going up to it. But nonetheless, I think that this is what is going to happen here, is that they're going to converge, and then a decision will be made as to what actually takes place. Is it really going to break above that and start to head higher and go up to these what are now resistance levels, or is it going to continue to meander and then break to the downside? Here is the energy level, and I just want to point this out. This is that trading range consolidation period that I was referring to, and we're in that phase right now, and you can see that it's actually quite low. If I flip back to the website and we come to the energy level, you can see ranked across 40 odd markets, all global futures markets. The 10-year notes and the 5-year notes are at the bottom. We got Australian dollar at the bottom, then natural gas, which is very quiet. Interesting things happening there as well, but I won't go into that tonight. Then the 5 and the 10-year notes. So they're actually quite low. If we look at the tendencies to the market, you can see here's the 5-year notes. When we get into a consolidation period, so there's consolidation and expansion. We're in a consolidation, low volatility. Here's the 5-year notes. That happens only 1% of the time. It just doesn't get that tight of a consolidation all that frequently. And if we look at the 10-year notes, it's double that, it's 2%, but it's still on the low side. Some of the other markets, 4.9, 4.5. So we don't get into this phase all that frequently, and so that's like a spring being wound up. There's something going to be happening. I did a similar deep dive a little while ago when I was talking about the S&P 500, and it was actually in the Russell 2000 as well, and we actually ended up getting an explosive move, I think even almost the next day. So if you want to look back, find the S&P deep dive, and you'll see what I was talking about. Well, we've got a similar nature here going on with the 10-year notes. So where are we going to go from here? I'll point out, this doesn't always happen. The 10-year notes, maybe not, here's the 5-year notes as well. 10-year notes are on the top 10 list as far as markets that are following seasonal tendencies. And yes, any market can have seasonal tendencies. You get corn, pretty obvious. Gold, are there seasonal tendencies? The answer is yes. And the 10-year notes and the 5-year notes, they have their own seasonal tendencies. So I'll just point out what they are saying. If I can find it here, I'll just come to accuracy on the right-hand side, and then go to the 10-year notes. And it is it's not that volatile, but you can see that we're at a low point here in the 5-year notes. Here are the 10-year notes, same exact condition. I know it's very hard to see because there just isn't a lot of volatility, and this has to follow the same format for all of the markets. And so when you have volatile markets like zinc, as an example, it skews things, and unfortunately, I'm forced to do it all in the same format, which causes the 5 and the 10-year notes to look like they're basically just going sideways. But you can see that the market does have a little bit of a pop to it. So the seasonal tendencies to the market are actually looking at the market rallying to the upside. Now, the question that I received in a tweet was, if they start to, they're looking at potentially, most likely, raising rates, but this is on a shorter term basis, where our systems will stay long and short the market, in some cases just for a few days. So the setup that we're looking at here, the consolidation on daily bars, I realize, the seasonal tendencies looking at perhaps the next week to 2 weeks or so to the upside. I think that what we really have to be watching here is the 50-day, which is this yellow one, and it's coming down very quickly. So they're going to collide. I think that for the most part, we'll just have to see how things actually do interact once we get to that particular level. And the fact that the market is very, very quiet according to the energy level, as well as I mentioned, the lazy day indicator. With this one, really doesn't happen all that frequently. And usually, in fact, here's one that did occur. It was 22 days, and as soon as this was over, we had an explosive move. It rallied, but this is the energy, or the lack thereof of energy, that caused the market to go into this trend to the downside. So now we're at the bottom of this little trend, and we have another consolidation. So I think that there's a lot of pent-up energy, and that there could be some good, very strong trading opportunities. The systems themselves are long the market, and so obviously with the seasonal tendencies and the systems pointing that out, the energy levels, the lazy day kind of pointing to some type of an explosive move occurring here, we're going to go with the long side, at least on a short-term basis, and see us run out there some profitability to have to be made on that side. So that's kind of where we stand right now. We'll take a look at another market tomorrow, and we'll kind of go from there. Thanks for watching. Bye-bye.